Hello everyone, welcome to the module 4 of Comparative Financial Systems. I'm the course instructor Mohammad Iftikharul Islam Bhuiya. In this module, we'll cover fixed income securities, and in this lecture, we'll cover a primer on financial assets. Let's look at the agendas of this module first. In this module, we'll cover a primer on financial assets, basics of bond valuation, money market instruments, calculating treasury bill prices, treasury securities, and more on bond market. So, what will you learn from this lecture? In this lecture, we will cover what is a financial assets, then how financial assets are different from real assets, and finally, what are important features of broad classes of financial assets. So let's look at what are the differences between financial assets and real assets. Financial assets are claimed to future cash flows. Investors of financial assets are entitled to receive cash flows generated by the financial assets. For example, bond, treasury bill, and stocks are financial assets. On the other hand, real assets are what produce goods and services in the economy. For example, land, buildings, machineries are part of real assets. Let's look at some examples of financial assets. A bond issued by the US Department of Treasury or by a corporation like Apple or by the state of California are financial assets. Bond can be also issued by the government of Greece or government of Bangladesh. A home mortgage loan is also a part of financial asset. In the meantime, common stocks and preferred stocks issued by corporations like Microsoft, Honda Motor Company are financial assets. Financial assets can be categorized in two broad types, a fixed amount claim and residual or equity claim. Fixed amount claims mostly include debt instruments. For example, bond, treasury bill are debt instruments, and these are part of fixed income market. Residual or equity claim includes both preferred stock and common stock, and these are part of equity market. Over here, preferred stock is a kind of hybrid type of security because preferred stocks resemble both the characteristics of debt instruments and equity securities. Preferred stocks provide fixed return like debt instrument. On the other hand, preferred stocks also represents ownership, and this is why preferred stocks are known as hybrid type of securities. Financial assets can be categorized based on their maturity. If financial assets has a maturity, if financial assets have a maturity less than 1 year, it will be part of money market security. If financial assets have maturity more than 1 year, they will be part of capital market security. Debt instruments with a maturity of less than 1 year are part of money market securities. So all the money market securities have maturity less than 1 year. On the other hand, debt instruments with maturity greater than 1 year are part of capital market securities. For example, bond is a part of capital market securities. In the meantime, both common stock and preferred stock are part of capital market securities. Let's look at the broad classes of financial assets. First of all, fixed income or debt instruments. These securities promise to pay a predetermined stream of cash flows to their investors in the future. Money market securities are short-term securities, and these securities have low risks. In the meantime, money market securities are very liquid, so investors who want to invest their money for short time and who prefer higher liquidity should invest in money market securities. On the other hand, bonds are part of longer term debt instrument and these are less liquid. Equities instruments represent residual claim and it represents ownership of the company. And finally, derivative securities are kind of contract, and these contracts derive from their value of their underlying financial assets. In our next lecture, we'll cover basics of bond valuation.